Welcome to this panel on ESG investing. I'm Sanjai Bhagat. We have an absolutely fantastic panel for you. First, we have Marlo Oakes, who's the treasurer of the state of Utah. Previously, he was the managing director at Crew Capital, an investment bank. Then we've got Aeisha Mastagni. I hope I got your name right. She's a portfolio manager at CalSTRS, and she's been with CalSTRS for almost 15 years, so they must like her. Then we've got Gerald Garvey, managing director at BlackRock, and he's been with BlackRock for over 20 years, so they must really like him. All of these individuals have their detailed bios on LinkedIn, so you can go look at that. But with that, let me start with the first question. So as of July of this year, ESG funds had 2.8 trillion of assets under management across the globe. 84% of these assets are in Europe, 11% in the US. Investment money flowing into global sustainable funds peaked in the first quarter of 2021. During the past 2 years, there has been a dramatic decline in investor interest in ESG funds, especially in the US. In fact, during the last 3 quarters, US investors have on net withdrawn their funds from ESG funds and invested in more traditional investments. There are literally thousands of studies that focus on the relation between ESG-focused investing and investor returns. Some studies have found a positive relation between ESG investing and investor returns, some negative and some no relation. However, the totality of the empirical evidence from academic finance research papers suggests a negative relation between ESG investing and investor returns. More specifically, in a recent Journal of Sustainable Finance and Investment paper, researchers surveyed over 1,000 primary peer-reviewed papers and 27 meta-reviews based on approximately 1,400 underlying studies published between 2015 and 2020. They documented a statistically significant negative relation between ESG-focused investing and investor returns. Why is there a negative relation between ESG-focused investing and investor returns? So, Aeisha, would you like to go first?
Sure, I'll start, but I have to say that I think it's a little bit of a loaded question because we don't, at CalSTRS, we don't do ESG investing. What we do is we manage a prudent portfolio and part of managing that portfolio is evaluating all the risks, especially for a fund like ours that has very long-term liabilities. And so we really feel like if we're not living up to our fiduciary responsibility unless we're incorporating all risks, which include environmental, social, and governance risks. But we have a duty to really make sure the fund is as diversified as possible, maximize returns, and minimize risks, which we do through our active stewardship activities.
Thank you. Jerry.
So let's think. In a way, I think I'll get rid of the easy because you can see from Ash's comments, you get an easy answer from academia, right? Which is that it's lower risk and therefore has lower returns, right? Totally expected. That's plain vanilla academia, and kind of related to that is, and I don't think it's right, but I can't what's the word, dismiss it. It could also be, or one, it's easy to see in theory if you believe in value and stuff like that ESG stocks tend to be expensive however you measure them. So if you believe in value, then all that stuff follows automatically. It also can be easily controlled, by managing your value. I think that's probably a bit too facile or a way to slide out of it. What I find, so we don't do, start off, we do not, in my group, we don't talk risk when we talk ESG. So we seek alpha. We have a risk model. We have a risk model we believe for years. We have a specialized risk group. And they talk about ESG risk, but they put that in a separate bucket from investment risk. So I am not much convinced by the linkage of ESG to risk. It's alpha. And that's cool if you do it well. But if you think about it, what people measure when they do ESG focused investing in meta studies and the stuff that's out there is usually based on ratings by agencies that are themselves not investors. And so, popular ratings, many people follow that are not done by serious investors. The more you dig into these ratings, the less appealing they seem. And so it's pretty simple to say, I'm not sure there is a negative relation, but I certainly could believe that. And in our book, in our actively managed book, we have quite a few signals that go that go against components of ESG. I sent you that paper that we published back in 2017 in Journal of Investment Management, documenting that a lot of what goes on in the S bucket, in particular for folks like MSCI, is just wrong direction, not even with returns, because as you know, returns are incredibly noisy. They also don't help you with what people call headline risk. Companies that have the nicest looking S scores often have much more and not less future controversies. So the execution is just the public ratings agency, or the ratings agency, not public, they charge a lot of money. The ratings agencies are, not surprisingly, the idea that you would make money by following what the score from one of the primary ratings agencies is just, if you believe that, then, anyway, it's that simple. So we have alpha seeking strategies, but they don't follow ratings, and that's what's in the studies.
Thanks, Jerry. Marlo, would you?
Yeah. So I when I think about ESG, I've often said that if there is an ESG factor that is financially material, then it's generally always been part of the investment analysis. And so clearly, if there's an environmental risk of some sort, then that will be figured into traditional investment analysis. And so, we really have to ask ourselves, what is ESG trying to accomplish? And I think that's where the problem is that if you look at ESG, we've gone from socially responsible investing, which was this idea that investors would try to align their portfolios with their values. But very importantly, they would allow different investors in the marketplace to have different views and to implement their own values or invest however they would like. They respected other investors, respected the marketplace. What we see with ESG is something very different from traditional investing. In fact, it's more active. It's more of an active approach to the markets, not even relative to investing. It's more active relative to political issues in a lot of cases. And so, for example, on the environment, pushing one acceptable narrative, pushing companies to net zero, for example, that seems to be a major push. How does that translate into investment returns? Now, granted, if there's a financially material risk there, the problem is oftentimes in the discussion around net zero, we're not talking about what are the financially material risks of going down the path of net zero, cutting off oil and gas, for example, and moving to renewable energy. There's tremendous cost there as well. So I very strongly believe that actually ESG isn't about investing. It's about other things related to the climate, related to whatever social agenda there is. Even the governance has changed. Governance was brought into ESG to bring credibility, but when you change from a shareholder framework to stakeholder framework, the G components change. So no longer are we talking about board independence or tying CEO pay to stock performance, for example. We're talking about demographic composition of boards, tying CEO pay to ESG metrics. These are not investor friendly. This is not the shareholder framework that traditional investors are used to. So I believe that the ESG investing discussion, we need to think about that pretty hard and recognize that I don't necessarily believe that it is about investing.
Yeah, well, three very interesting perspectives, quite different, but very, very insightful. So thank you. I mean, would any of you like to comment on the I guess comments that have been made so far, or would you like me to go to the next question? I mean, we can always come back to this.
I don't think I would just agree with what Gerald was saying about the ESG ratings. It's one of those things that, we really don't spend a lot of time. We like to do our own analysis and due diligence. And it's just part of our responsibility given, we're a universal owner. And so we own everything. And so we use our stewardship activities and some of these things to analyze risk inside the portfolio because of the structure of our investments.
Yeah. No, I mean, I think the ESG ratings have been very controversial, and for good reason. They tend to be inconsistent with each other. Often they don't, make they don't pass the smell test. You look at two companies that are clearly, pulled apart with regard to their environmental records, and their ratings are in the opposite direction.
Well, Sanjay,
but
just to add to that, I think there's a reason for that, those differences, and they're important to have those differences. Anytime, a lot of this analysis is on subjective criteria. And when you have subjective criteria in a marketplace, you should have different answers to the value of those subjective criteria. If you push to one correct answer, then you no longer have a marketplace. And that's, I think, one of the biggest challenges with ESG. When you're pushing an agenda in the capital markets, you are no longer pushing for markets. You are actually destroying markets, because having one correct view, if you're pushing for one correct view and saying everybody has to do net zero, or everybody has to do X, Y, or Z, whatever it is, then you no longer have a marketplace. And that's why this is so problematic.
So,
yeah,
in fact, and maybe pile on the raters, maybe we'll bury them and move on. But it's even worse than that. When they agree, that's when they're really wrong. Seriously, because the agreements tend to be driven by company disclosures, which are heavily managed. And so what the agreements often, especially on who's good, often very much like the original work we did, tend to really zero in on the companies that are actually vulnerable, not virtuous. So yeah, the rating stuff is really, it's unfortunate. It seems like such an easy answer. And I guess the only other thing I have to say, mostly for CalSTRS, recognizing, remember, they're actually asset owners. In recognition of that, we've actually introduced voting choice, where we vote if our actual asset owners want us to vote, but if they want to take the votes themselves, they can actually choose to take the vote back and vote however they like, which is because it's their money after all. We've seen some interesting ones, very similar to what you documented in Europe versus the U.S. The owners like CalSTRS can choose either to vote directly or to vote with different policies. And in Europe, almost everybody goes with what ISS calls essentially the environmental or the green or the SRI policy. And in the U.S., when people deviate, they tend to go for what's called board focused, which basically means vote with management. Very interesting. So there's definitely a lot of there's a lot of disparity in views by region on how you vote your shares. Right.
True. No, my comment on ESG rating was not, not inconsistent with what you were saying. My comment was more with regard to ESG rating and investor returns, was that studies, or many of the studies that have looked at this, they have sort of just gone with fund families labeling of, say, sustainable funds or ESG focused funds, or the UN, principles of responsible investment signatures. So they, I think, many of the studies have tried to get around this ESG rating issue by saying, okay, we'll just go with whatever the fund says it is. If they say they are sustainable or ESG focused, we'll take them on their word, and then we'll compare their returns with other funds that aren't making that claim. Anyways, that was the point. But with that, let me move on to question 2. In the US, 79% of energy consumption comes from fossil fuels, while 13% comes from renewable energy sources, according to the Energy Information Administration. That's after tens of billions of dollars in government spending in support of renewables, particularly wind and solar, which combined account for a mere 5% of our energy consumption. The bottom line is that so-called renewables are insufficient and lack the necessary dependability to meet our energy needs. Despite this heavy fossil fuel dependence over the past 2 decades, carbon dioxide emissions in the US have declined by 15%, while carbon emissions in China have grown by 216%, according to the Energy Information Administration. The US emission reductions were due in large part to an increase in the use of inexpensive and clean burning natural gas, which thanks to fracking, the US has and can produce in abundance. If the goal is actually to reduce global carbon emissions without causing global economic chaos, would increased use of dependable and abundant American natural gas not make far more sense than curtailing US production and spending billions on unreliable and expensive renewable energy sources? So, Marlo, would you like to go first?
Oh, sure. Yeah, no, I think this is, one of the challenges with sort of top-down deterministic activity like ESG that says we have to move toward renewable energy. This is the first time that I'm aware of that we are saying everybody needs to transition to something instead of leaving it to the markets as to when that happens and how that happens. The result when you start moving away from markets is you have a misallocation of capital, and it can be very, very expensive. If you think about markets, there's tremendous power in markets. I remember in graduate school, one of my professors wrote a very famous paper on orange juice futures markets versus meteorologists, and who's better at predicting the weather? Is it the experts or is it the markets? And it turns out that the markets are better. And so when we talk about moving or transitioning to something, what are we transitioning to? And are we forcing that transition with some sort of top-down centralized control edicts? And that's what I fear is happening with ESG, and it will be very expensive. It already has been extremely expensive. And as you can see from just the development in the United States through technology, through economic freedom, the innovation that has happened, we have cleaner air as a result. And frankly, our natural gas burns cleaner than Russian natural gas. We should be pulling more natural gas out of the earth and burning US natural gas around the world because it would be better for the environment globally. So, these kinds of activities, when you talk about shutting down the US natural gas businesses or curtailing them significantly, that belies something else is going on other than the environmental agenda that seems to be out in the forefront. And frankly, I don't believe that it's necessarily an environmental agenda that is really being pushed.
Aeisha? Thank you, Marlo.
No, I think the only thing I would add is that, we're not, at CalSTRS, we have one responsibility. It's to provide a safe and secure retirement for the teachers of California. And so what we need to do is, prudently manage a portfolio that produces returns so we can provide that benefit. And I think it's funny sitting in California, there's a lot of different talk throughout the nation. In California, we often get what we call the divestment activists that come to us and ask us not to be invested in certain sectors, companies in the market. And, right now, the fossil fuel industry is a target of a lot of those advocates. But, going back to what I was saying at the top is, we have a fiduciary responsibility to diversify the fund, and anything that takes away from that diversification adds risk to the portfolio and therefore makes it harder to achieve our returns. And I think that we can't, divest away from some of these risks. It's important for us to be mindful of what our goal is. And we think that we can provide those returns and ultimately manage the risk appropriately by being active stewards of that capital.
Thank you, Aeisha. Jerry.
So Marlo, you just outed yourself as a UCLA person. Me too. I'm actually from econ, which in its day was called University of Chicago at Los Angeles. It's if you recall, Sanjay knows all this. Shanzi knows these stories quite well. What first one is, I mean, as always in these things, there's an easy out. You learn this when you've been around for a while. You could claim, that ESG doesn't have anything to do with this. This is just, misguided government policy, of which there is no lack. But it is interesting to notice, that we looked at this about a couple of years ago. It is actually true in the past decade. There has actually been a reduction in capital expenditure in the energy sector, which was quite surprising, in traditional stuff. So there definitely, I don't know if it was, ESG that did it or divestiture or cost it something, but it definitely stands out. It might also be, forecasts of energy prices. Who knows what it was, but it is quite notable. So it's something we really need to take seriously. I do not know enough about fracking to that's part of Marlo's point about, I guess, about the market. I sure don't know. I'm not an energy person. That's what the world is for, to figure out. I am encouraged to see people being a lot more open-minded about nuclear. That would be also a nice thing, I think, for all of us. I would add sort of just one other, hopefully sort of hopeful and helpful angle, which is one thing that's missing, at least from the way emissions are treated in the investments world, is any sense of what the world needs to run. What people call green and brown. Right, you see portfolios that are called green versus brown. The only problem is a green portfolio doesn't correspond to a world that would work, because you basically have no energy. And it's really easy to make a portfolio look green. You just short a couple energy companies. They're incredibly concentrated by company and by industry. And it's absurd, right? You shut them down and then everything else can't work either. And unfortunately, the industry has gotten themselves caught up in this loop called, oh, that's scope 3, and the data is not available, which is it's incredibly unhelpful. We have a paper coming out in Journal of Portfolio Management that I'd like to think is a little better, where we actually try and model properly, what energy and what emissions have been embedded in final consumption globally. And I don't know, I have to end on a hopeful note. It's absolutely true that China's emission during that period grew enormously, but most of it was actually all about construction. Mm-hmm. The building boom in China was responsible for a huge amount of global emissions, not just within China, but in red dirt from Australia and everything coming around the world. And the nice thing is that's built. It's already built. So it's a capital good, and now building is slowing. It's not much fun for Chinese banks and real estate, but it's actually get the point. You could live in the buildings. You've made the emissions. They're embedded in the buildings. Use them. So that one will probably fix itself just by flat out, durable goods. So for me, the only real tragedy is when you see people dynamiting buildings in China. That's the one where you go, oh no, this is not. Don't do that. Use and maintain the buildings. So I always have to end on a hopeful note.
So Gerald, I think you had mentioned about sort of underinvestment in fossil fuel. Is that right?
I don't know if it's under. All I can say is if you just literally do, the sum of capex by sector, energy stands out as low.
Mm-hmm. Yeah.
Whether that's underinvestment or over, you remember Jensen used to claim there was overinvestment in energy, right? So I don't know if it's overinvestment, but it's definitely less than other industries.
Yeah.
That's
so
for sure.
One of the statistics or some of the information that I've looked at. For example, in private markets data from Preqin, back in 2015, if you look at North American oil and gas partnerships. Money that was raised for those partnerships. Back in 2015, it was something like $50 billion. In 2021, it was 3. So a drop of 94%. The only explanation for that is ESG. You had a little bit higher going back, but really this drop off in 2023, that's really when we saw ESG take on a life of its own. When the Biden administration came in, they started going around and meeting with banks, signing them up for net zero climate, commitments and things of that nature. And so I believe we're facing a very serious underinvestment in oil and gas that is going to be a problem for quite some time.
You're absolutely right. I mean, just for full disclosure, the number I quoted to you was the sum of CapEx by listed companies. So it would be blind to what goes on in the privates.
Right.
Yeah. Huh.
Yeah, no, this under investment in the energy industry, even that you mentioned from the public companies, at least the data are from, but I imagine that would be similar for private. And the reason I believe that is if you're going to make energy exploration and development, more costly through regulations, through litigation, then I guess the rational economic response is the company will do less of it.
Yeah.
So
I'm gonna have to update my numbers. That's really interesting because we were actually concerned that we might just drive all this investment into the private markets, right? We complain.
Yeah.
So my friends in Alberta keep telling us that. That we're just, you get the point, right? We're yelling at BP, and so all that happens is it goes to state-owned enterprises and privates. But you're telling me that the privates have shrunk as well, huh?
Well, okay, yeah, and my
interesting.
My statistic is
Wow.
on GPs and the raising of capital among large institutional investors. So this is for oil and gas projects.
Oh, okay.
Yeah, so it could be
interesting
projects.
No, I think there are both effects, that you have movement from public companies to private companies, but then even private companies have to face EPA litigation, EPA regulation, other regulations. So they're the investors ultimately at the base have option to go private or public, and they are looking at this I guess the environment where energy exploration and development is under attack, I guess. We can come back to this later if you like, but let me go to the third question, which is most of the processing of the minerals needed for electric vehicle batteries happened in China. Using wind, solar, and batteries for energy production and transportation requires significantly more metals. 3 times more copper, 7 times more rare earths, 19 times more nickel, 25 times more graphite, and 42 times more lithium than natural gas, oil, or coal production and transportation. The US mines and processes a negligible amount of these metals, which primarily come from countries such as Australia, China, Congo, and Indonesia. Notably, 60% of rare earths are mined in China. Chemical processing, battery components, and assembly are mostly done by Chinese companies. China also processes 87% of rare earths, 65% of cobalt, 58% of lithium, and 40% of copper. As a result, China's economy has benefited significantly from the global push toward renewable energy. Of the 12.7 million jobs worldwide related to renewable energy, 5.4 million jobs are in China, 0.9 million jobs in the US, and 1.2 million in Europe. Of the worldwide jobs related to solar energy manufacturing, 68% are in China, as are 48% of jobs related to wind power. The current excessive focus on green energy policies are needlessly weakening the US and strengthening China. Since the 1970s, with the help of its innovative energy industry, America has finally won independence from OPEC. How much sense does it make to implement policies that weaken our economy while once again putting our access to energy at the mercy of a hostile and even more dangerous adversary? So, Jerry, you want to go first with this?
Yeah, you probably noticed I tend to go hopeful and positive.
Let's keep it that way.
Yeah, first one is this is history. We're actually apparently there's monstrous rare earths discovery in Sweden. This is what happens when stuff gets scarce. Speaking of markets, no, seriously, we may soon be sourcing a lot of this stuff from there, which is people go where it's cheap and easy, and I like to think, and hopefully, places like Congo will become a little less attractive for that. One other factoid, I mean, I'm a really bad economic nationalist. Meaning I don't do that. I'd never get elected these days. I'm not sure I view employment in China as a bad thing. In particular, I mean, the one thing it's still, to be honest, the thing that worries me more about global stability right now is youth unemployment in China. That's, devil finds work for idle hands. There's 20%, something like that, of young people who lack jobs in China. So I'm not sure that having jobs in China wouldn't be good for the world. People tend to get pretty desperate when they're bored. And so, yeah, I think the labor angle is really important, and actually just seeing, who gets employed where, et cetera. But I wouldn't mind so much, yeah, seeing young people in China actually being able to find jobs, maybe also get married and all that stuff. It's probably, I've heard it leads to better behavior.
Aeisha. Thanks, Gerald.
Yeah, I mean, I don't really think that, like Gerald, I'm not really a global policy. That's not my area of expertise. And so, we recognize, I mean, emissions in our portfolio come from all parts. And a lot of those are Chinese and, Russian companies. And so, what's difficult for us there is, we don't necessarily have the expertise, the tools to engage those companies. So it's one of those where we try to focus on, where we do actually have the skill set and the means to effectuate change. And so, like I said, for us, it's really about, managing the portfolio and not necessarily, we do advocacy work, on policy, but it's really, for things that we think affect us as an institutional investor, and making sure that we have well-functioning markets in which we can operate.
Thanks, Aeisha. Good perspective. Marlo.
Yeah, I would say this has been one of my concerns, just in sort of this push to renewable energy. If you think about sectors that are critical to an economy, energy is one of those, agriculture being another. And energy, we reached energy independence here in the United States, which is something most people thought unattainable. And then we've turned away from it, and we're seeing serious underinvestment in the energy sector, as was stated earlier. I do think it has national security implications that we need to think long and hard about, and recognize that a lot of the renewable, whether it's solar or wind, we are more dependent on China. China has been, much more adversarial recently, and I would make a distinction between, the Chinese people and the Chinese Communist Party in that. But I do think that we need to be very cognizant and aware of what this push to move to renewables. Not to say that there isn't a place for renewables, but we need to be smart about it, because energy is a critical component of any prosperous society.
Jerry, it sounded like you wanted to say something. So I mean, like I think in general, I agree with Jerry that trade is good. Amongst nations, amongst individuals, trade is a good time. That's one of the basic stuff you learn in Econ 101, maybe 102. So that's all. That's fine. But here when, like I think as Marlo hinted, when national security may be at stake, that's when there's an exception to trade is good paradigm or theorem. I mean, more specifically, here, I think in 2019, we were actually, for the first time, exporting oil and gas. So we had become energy independent of OPEC. Now, if we have an overemphasis on electric vehicles and other green energy policies, at least for electric vehicles, batteries, we have to rely under current technologies significantly on China to provide us those batteries and so forth, including many of those batteries to be used for our military vehicles. So the question is like, if we go the oil and the gasoline and diesel route, we have plenty of that in this country right here. On the other hand, if we go the electric vehicle route, we have to depend on another country which is sort of at least not neutral. I mean, how hostile they are depends on your perspective. Do you want to depend on them to provide us the components of these batteries and those batteries themselves? Now, I think, again, I'm sort of sympathetic to Jerry's viewpoint that, it's a good idea for young people in China to get jobs and be working. I think it's a good idea for people anywhere in the world to be working, old or young. But I think it is especially a good idea for people in the US to be working. And, by exporting away some of our blue collar jobs, I mean, that's runs counter to the argument. So, I mean, I would like to have, our workers have jobs, their workers have jobs. But if there's a choice to be made, I'd rather have the job stay here. And, by saying, okay, we will not make these gas and diesel cars and trucks here, we will, import these electric vehicle components from China. I think there is a employment issue there. Now, over the long run, so besides this employment, there is like, in the short run or even the intermediate run, which can run to 15, 20 years, we simply do not mine and more important process most of the metals that are needed for this green energy economy. Whereas if you go with the traditional, oil, gas, coal, I mean, we can do most of it here. And I think is an argument that has often been lost in this discussion.
Well, I would add that, a lot of the demand for these minerals is really sort of this industrial policy of pushing the economy, to adopt electric vehicles, for example, or solar panels or whatever it is. This is not coming from the bottom up. The demand. I mean, you see that with the amount of automobiles sitting unsold on car dealer lots. This points to another, what I think is a national security risk potential, and that is the misallocation of capital. When you have a ton of money being spent in areas that don't necessarily lead to economic outcomes, you end up wasting a lot of money, and can become vulnerable as an economy.
I just want to chime in here too, because I think that I want to be really clear that, we at CalSTRS believe that, climate change is one of the greatest threats to our future, that it poses serious risks to our CalSTRS investment portfolio, our ability to provide benefits to the teachers and make sure that they have a livelihood in a world that they can live in. And so, we take a holistic approach to how we manage the portfolio, which means, accounting for all of these risks. We think there are risks and opportunities that come with achieving a net zero world. And, but we recognize like we can't do it alone. We need the governments, businesses, investors, the communities in which we operate to work together towards achieving that, because I think it's all in our best interest if we have a, healthy, net zero economy, but one that we all want to live in.
One thing,
Good point.
national security is tricky, right? I mean, I would say one thing I can say just analytically, we actually ran with the same analysis we did for like full supply chain emissions. You could actually ask who would be the biggest beneficiary from a ramp up in U.S. defense spending, right? Just a quick one, like where does the money go to primarily? And the biggest beneficiary by far is Mexico. There's just there's a lot of heavy stuff. Just all through the military goes through Mexico. Now, that said, of course, as you probably know, my colleagues are looking at me right now. We all know also that a lot of Chinese companies have set up in Mexico. So that's kind of more positive than normative. It kind of says, trade is probably more like gravity. It's just there and it will find a way. But maybe it's not so bad for security. I spent too much time taking history as an undergraduate. And there's an awful lot of cases where belligerents are trading with each other, and the one that does the best job of trading actually wins. Even the little nation of Holland during their revolt against the Spanish were massively trading, in fact, selling guns to the Spaniards, and they won. And they won because they did a good job of it. So that's I guess I must be a really deep, ultra microeconomist, right? Trade is good even for security, but I'm not a defense person.
No, I mean this kind of historical, I think historical example anecdotes, I think, are very, very useful and often very informative. I mean, let's look at, if you go back and look at the history of empires or countries, the last 2,000 years or any part of recorded history, you'll never find an example where a country became militarily powerful without a strong economic base. The corollary of that is not true. Recently, or at least in modern time, Japan and Russia had strong economies, but they chose not to be powerful militarily. But it sounds that within the last few years, they may have had a change of perspective on that. So, there's this argument that, that I'm saying, or this, theorem that no country or empire has ever been militarily strong without a strong economic base. So things, so to the extent that some trade helps your economic base, that's good. But if you are trading with your military rivals, if you will, and if you're trading in a way that makes their economy better off than yours, then I think you have a problem here. I mean, this is not all theoretical. You ask the U.S. Navy ships in the South China Sea when they are under constant threat of military action. To them, it's real.
Yeah, it's funny. We have a lot of Taiwanese colleagues, right? So we certainly feel this, right? It's pretty salient to them. But again, amazingly, right? As you probably know, they don't do direct trade with China, but if you do any kind of supply chain, they're also deeply interlinked. So I'm not even sure you have a choice. Kind of do trade.
Well, I would also point out, I guess, the difference between the benefits of trade and the implementation of policies at home that may harm you. For example,
right.
If we're pushing to go renewable because of the policies in the United States, that's different than trading with China, where they have the renewables,
right.
and so we're in a lot of cases harming ourselves by our own policies. And that's independent of the trade argument, I would say.
I think we have some time if there are any Questions from the audience, Michelle?
I'm really impressed so far at the breadth of topics that you all have managed to cover in this very short amount of time. And I thought it was, at the very beginning, Jerry, you talked about ratings, which I thought was really interesting. At our Applied Finance Conference in May, we had some representatives from Fitch on the ESG panel there. And he really did talk about kind of what you talked about, in that, we lump ESG together. But there is such a dichotomy of the risks and, the investments that companies make in those three separate areas, E, S, and G. He pointed out that there's a lot of really strong, really large companies, a la like Exxon, for example, who have really strong governance ratings. But you might not say the same about their E or S ratings. Right. But when you're giving kind of one number or one rating to that company, if it is, so heavily weighted in one of those factors, it's hard to kind of dissect the information that people might be looking for. So, yeah, I'm impressed at the breadth of topics that you guys have talked about. But I also know that what you're talking about is also reaching places like Fitch and the other rating agencies as well.
I spent a lot of my life actually arguing with the agencies. We don't use their data, and sometimes we short them. And sometimes we short them. I mean, again, some of our signals actually we turn out quote bad by their metrics, and we're quite intentional about so doing. But it is. I mean, when you drill into some of those, it's not even that they disagree across dimensions. You dig into it. We often find it where we find a company that gets downgraded, or we have to, in some of our funds face some divestiture criteria, and you dig into why. We just had a really harsh one with some of the big tech companies, as you might imagine. Excluding them from a long-only portfolio is a massive underweight, right? This is a hugely important investment decision, and you dig into it, and it turns out that the reason that they got downgraded is called labor risk. It turns out that labor risk in this case is just because they hired a bunch of people, and that's a downgrade. So, right, exactly. Like, wow. We were just talking about job creation. Well, sometimes it's the less we, hopefully, the rating stuff. I think it is getting better, mostly just because we're all backing off them. I think as much as we can, and we've had a few wins. With actually literally getting them to change or improve some of their metrics, but it's when you actually dig into it, a lot of the stuff is pretty casual and
right.
Not really well thought out.
And it differs from agency to agency.
Yeah. Well, that's what happens when you're doing noise, right? When you're doing random stuff, it'll also be a little different across agencies. To me, I don't know if you wanted to. I think the biggest thing that I think we actually don't do a lot of materiality stuff in our funds either, mostly because we don't really think we know exactly what's material. I'll give you an example. We think about emissions not so much as a future regulatory risk or some such, but just as a measure of efficiency. It's just a measure of indirect input use because emissions are so ubiquitous. And if you follow the logic of that, and we've actually had quite a bit of success with this, it's actually quite meaningful for industries that are actually generally quite carbon light. So if you find distributors or wholesalers, et cetera, that reduce their emissions, it usually indicates a pretty big change in their efficiency, and that wouldn't get flagged as material using the standard materiality criteria. So we just view ourselves as we see some data. And we ask, what does it tell us about the company? Knowing that by definition, companies are big and complex. We'll never know anything about a company. But if I see a piece of data, what does it tell me? And in this case, for example, a change in emissions for a low emissions industry is actually a big deal and shouldn't be downgraded with materiality talk. Another way of thinking about it is our job as investors is actually prediction, not causality. And a lot of the ESG stuff gets confused with that. It's like you claim that you're actually causing something, and it's a very high bar, especially given that most of our studies are associational, not experimental.
Yeah, true.
And again, the good news for us is our job is just to predict, right? We have to overweight and underweight equities and to predict that they'll do better or do worse. Whether we got the cause right or not is, frankly, we don't have enough. Well, clients don't actually care, right? I don't think we care. If we got the right companies doing the right things for reasons that we don't profoundly understand, you see employee turnover. Is that because employee turnover is evil? No, it's because employees tend to leave a sinking ship and they know more than we do. Okay, that's so the real signal that it's a sinking ship. That's again, it's not really causal, but it's really useful information. And you could call it ESG, but that just means it's broadening the range. And as Marlo said, in many cases, many good investors before ESG were also doing this.
Yeah, and I, it brings to mind a distinction that I like to make when we think about ESG investing. There's the ESG part that we see, which is the ratings and the information. There's the part that we don't necessarily see as investors, and that's the engagement. And to me, that's the most dangerous part of what we're talking about. When we have people going in and engaging with companies and changing those companies, that affects everybody in the marketplace. So, for example, if an investor goes into a large oil and gas company and says you need to adopt net zero, and you need to cut oil production by 20%, it impacts everybody in the marketplace, whether you agree with that perspective or not. And that's why ESG at that level is no longer investing. It is counter to our free market system. And actually, we will have an ESG economic system, or the economic system that ESG brings in, or we will have a free market system. If we go down the path of the engagement and the coercion, which is happening in the marketplace, we will destroy our free market system. And that is the greatest fear that I have.
One positive thing is, I have to do positive again. We've had a lot of bad press about this, but actually it should make you feel better and actually makes me feel okay. Is it? You probably know this, right? That a lot of activist proposals are not getting much support these days. Right?
Yes,
there's been a big blowback on that, and that includes us.
That's been good. What's interesting, though, is if you look at the proposals that the BlackRock actually voted against, if you adjust for the ones that they voted against because they had engaged with the company and the company was already implementing the policy, then the percent goes up to 56% from 7% support for ESG. So that's the one part that, again, people don't see it. And it's in my mind the most dangerous, because then you're moving away from a market-based system to one where you're using coercion with money.
Yeah, but okay, so I'm gonna have to chime in on this one, because obviously what we do a lot at CalSTRS is engage with companies, but I also think that we have the right governance systems in place that allow that free market to still happen. I mean, if you go back 2 years ago, I mean, I was the leading driver, along with engine number one, to appoint new directors at ExxonMobil. And we did that because it was a company, it wasn't about ESG or big bad oil. It was a company that had seen declining returns on their invested capital. And so back to kind of what we were saying earlier about actually, CapEx and what they're returning. And it was a company that had consistently rejected engagements with their shareholders, their owners. And so my point, Marlo, on this one is that we wouldn't have been able to appoint those new directors unless the broad market agreed with our assumptions and our arguments. It was the value of the argument that made it our ability to appoint those directors. And so none of this was yes, we had behind the scenes discussions with companies, but the systems in place that allow shareholders, who are the actual owners of these companies, to have input on who's sitting inside those boardrooms is a really important governance piece.
And sort of, fiduciary duty is immensely powerful. I didn't even realize. Yeah, exactly. I was about to say, in 3 cheers for fiduciary duty in this sitting. I actually hadn't come to appreciate. I've actually been working with our stewardship team the last 2 years just to have how, well, I guess if you're an activist, how confining it is, or you can just say how stringent and meaningful it is. The number of things that we cannot and will not do because of fiduciary duty is enormous. And Sanjay, we actually had a research project with some very prominent people, including a good friend and Nobel Prize winner, who was arguing for essentially more activism by large investors. And that research effectively ended up getting curtailed because we really could not agree or even get people to understand just how serious fiduciary duty was. So the stuff they're talking about in their papers, et cetera, just can't be done. And that's almost surely a good thing.
Jerry, I think maybe 2 years back, I had a debate, online debate with the same Nobel Prize winner. So you could go and watch the debate for my input. Anyway, with that, I would like to first offer a very strong and energetic vote of thanks to Aeisha and Marlo and Jerry for an outstanding set of comments and an outstanding panel discussion. And Michelle, over to you now.
Yeah, I echo my thanks. I'm just looking at the notes that I've taken during this panel, and there's so much that intersects with what we see in terms of research, even on next week's program in Chicago. Labor finance, shareholder activism. Shareholder activism has been, well researched in the last couple of years, but it is so ramped up. Labor finance, especially since the COVID eras, so much labor reform, so much restructuring. Of course, climate finance as well. We see that there are journals with special issues on that now. So again, I mean, this all ties into research so well. I'm glad that we had this discussion because for the academics that are on this the seminar, and I see that the majority are academics, I think this will spur a lot of good research ideas that is really applicable to the industry in the future. So thank you so much.